The shift didn't arrive with headlines. It arrived with silence. According to some analysts, while public attention stayed fixed on inflation prints, rate cuts, and stock indices, something quieter began unfolding beneath the surface of the silver market. Large institutions started adjusting exposure without press releases, without bold calls, without urgency. Positions were trimmed here, accumulated there, rolled forward instead of closed. Here's what nobody tells you. When Wall Street moves loudly, it's late. When it moves quietly, it's early. And right now, silver sits at the center of a repositioning that looks less like speculation and more like preparation. This is where the pattern begins. Silver has never been just another metal. In the late 19th century, battles over silver and gold-shaped monetary systems across the United States and Europe, culminating in the abandonment of bimetallism and the consolidation of central banking power. In the 1930s, silver purchases by governments distorted global trade flows and helped pull metal out of circulation. In 1980, when prices surged toward $50 an ounce, it wasn't jewelry demand driving the move. It was a collision between monetary fear, leverage, and concentrated positioning. Each time silver mattered most, it did so quietly at first, before becoming unavoidable. Today's context is different, but the echoes are familiar. Silver is no longer central to currency systems, but it has become embedded in industrial infrastructure. Solar panels, electric vehicles, advanced electronics, and defense applications all rely on it. According to industry data from the early 2020s, solar alone began consuming more than 10% of annual silver supply. At the same time, mine output struggled to grow meaningfully, constrained by declining ore grades and underinvestment following years of low prices. Not abundance. Tightness. Here's why this matters. Wall Street does not reposition based on headlines. It repositions based on forward risk. According to some economists, institutions increasingly view silver as a hybrid asset caught between two worlds, industrial necessity and monetary hedge. That dual role makes it sensitive to multiple stress points at once. If growth accelerates, industrial demand rises. If confidence falters, monetary hedging demand appears. Silver doesn't need to win either scenario to matter. It only needs uncertainty to persist. At first, it looked like nothing. Prices drifted. Volatility compressed. Commentators lost interest. Then subtle signals emerged. Open interest shifted across contract months. Inventory reports showed drawdowns that didn't align neatly with seasonal patterns. Some large players reduced visible exposure while increasing indirect positions through options or structured products. Let me show you exactly how this works. Institutions rarely place all their conviction in outright directional bets. They reposition by changing how they are exposed, not just how much. This is the unseen rule most observers miss. Public narratives focus on price. Institutional narratives focus on structure. According to some market participants, the question was never, will silver explode tomorrow? It was, where does silver sit if multiple systems are under strain at once? Inflation uncertainty, energy transition costs, geopolitical fragmentation, and debt saturation all feed into that calculation. Not hype. Hedging. There's also a geopolitical layer that rarely makes headlines. Silver production is geographically concentrated, with significant supply coming from countries that face political, regulatory, or infrastructure challenges. At the same time, demand growth is tied to strategic industries governments want to protect and expand. If this pattern applies, silver stops behaving like a passive commodity and starts behaving like a strategic input. And strategic inputs are rarely priced only by spot markets. They are priced by access, contracts, and long-term positioning. Everyone thought the calm meant stability. They were wrong. Calm often means alignment, not safety. When too many participants agree on the same benign outlook, markets become fragile. According to some analysts, the quiet repositioning suggests that large players are less confident in that benign view than public pricing implies. They are not predicting collapse. They are preparing for asymmetry, situations where outcomes are uneven and volatility returns suddenly. Here's the trap for observers. Silence feels like irrelevance. A lack of headlines feels like a lack of conviction. But Wall Street's most consequential moves often happen when there's nothing to distract attention. When repositioning is complete, narratives change. Analysts publish reports. Media rediscovers the story. By then, the risk has already been transferred. The unresolved question lingers beneath the surface. Are these quiet moves defensive, positioning for disruption, or laying groundwork for something more aggressive? According to some scenarios, the answer depends on a mechanism that hasn't fully revealed itself yet. one where industrial demand, financial leverage, and geopolitical tension intersect at the same point. And when that intersection becomes visible, silence will no longer be an option. The second phase of repositioning is never about accumulation alone. It's about optionality. According to some analysts, once institutions have adjusted baseline exposure, they begin shaping payoff profiles for futures that feel plausible but not yet priced. This is where silver's role becomes more complex. It is no longer treated as a simple bet on inflation or growth. It becomes a conditional instrument, one that responds differently depending on which stress emerges first. Here's the mechanism Wall Street quietly respects. Assets that connect unrelated risks become disproportionately valuable when systems stop moving in sync. Silver sits exactly at that intersection. On one side, it is tied to industrial policy. Governments across North America, Europe, and Asia have committed trillions of dollars to energy transition and electrification. Solar capacity targets alone imply sustained silver demand well into the 2030s. On the other side, silver remains linked, psychologically and structurally, to monetary distrust. It trades alongside gold during periods of currency stress, but with higher volatility and thinner liquidity. Not tradition. Tension. This duality is why repositioning rarely looks dramatic. According to some economists, institutions don't need silver to outperform everything else. They need it to behave differently when correlations break. If equities fall because growth slows, industrial metals may weaken, but monetary hedges may strengthen. If inflation reaccelerates, industrial demand and hedging demand could move together. If policy credibility erodes, even modest shifts in investor psychology can push capital toward tangible assets. Silver doesn't have to dominate any single scenario. It just has to survive all of them. At first, this kind of positioning looks inefficient. Returns appear muted. Carry costs exist. Opportunity cost nags. Then the bill arrives. Volatility returns. Correlations snap. And suddenly assets that looked boring become anchors. According to some market veterans, this is why Wall Street's most meaningful bets often look like indecision to outsiders. They are not chasing returns. They are buying resilience. There is also a structural asymmetry at play. The silver market is small relative to global capital pools. Daily liquidity is finite. If a marginal increase in institutional demand collides with constrained supply, whether physical or deliverable, the price response can be nonlinear. This is not a prediction. It is a property of market structure. Small doors move violently when too many people reach for them at once. Here's what nobody tells you about who benefits. It is not always the loudest bull or the most vocal skeptic. It is the participant who understands timing and scale. According to some scenarios, those already positioned can afford patience. Those who wait for confirmation often arrive when risk is highest. This is why repositioning happens before narratives shift. By the time consensus forms, optionality is gone. There is a broader lesson embedded here. Silver is a case study in how modern markets process uncertainty. Information is abundant. Signals are constant. But meaning is scarce. Institutions filter noise by focusing on structure, supply chains, leverage, policy constraints, and geopolitical friction. Retail observers filter noise by focusing on price. That difference in focus creates recurring gaps in understanding, not ignorance. Perspective. Here's the trap. Watching silver only when it moves reinforces the belief that nothing matters when it doesn't. In reality, the most consequential decisions are made during the quiet stretches. According to some analysts, if repositioning continues without public attention, it suggests confidence and preparation, not urgency. Urgency comes later, when preparation is no longer possible. The final tension is unresolved by design. Will silver remain a background asset, quietly absorbing institutional risk management flows? Or will a catalyst, policy shock, supply disruption, or monetary stress force it into the foreground? If this pattern applies, the answer won't arrive gradually. It will arrive suddenly, when silence breaks and positioning is revealed all at once. Because by the time everyone agrees that silver matters again, Wall Street will already be asking a different question. What comes next after preparation turns into reaction?